I want to talk to you about partnership taxation. And so here's the overview I want you to pay attention to. The first thing I want to discuss is that the way partnerships are taxed. Okay. So when we talk about partnership taxation, we first need to understand what a partnership really is. So a partnership is really a business form where two or more individuals agree to operate as co-owners. So partners actually can have any share of ownership, but the total percentages must equal 100% always. You got to have this sort of arithmetic sort of proportions here. So when it comes to partnerships, many people tend to think of the general partnership. There are also two other common partnership types besides the GP, of course. So you have the limited partnership LP and the limited liability partnership, the ALP. So when we talk about general partnership, in a general partnership, you have two or more individuals who share the management of and personal responsibilities for a business. And this is basically, based on our research, the simplest structure you can choose when starting a business with one or more partners. Okay. Now, the requirements for creating a general partnership are straightforward. So there is no need to file specific state statutes before creating a general partnership, because a general partnership, when you really think about it, is not a statutory business organization. That's number one. And to form a general partnership, you establish an agreement with one or more partners, and the agreement can be verbal, but it is advised to have it written and signed by all partners to help avoid any conflicts down the road. You never know. You never know. So this agreement should actually establish each partner's responsibilities, duties, and rights. Essentially, anyone can be a partner. So a partner can be an individual or a partnership, limited liability company, corporation, or trust. So that's for a general partnership. Then you have limited partnership. So the limited partnership is actually made up of two types of partners. So you have general partners, and then you have limited partners. So this business structure can be seen as a cross, if you will, between a general partnership and a corporation. So where limited liability protection exists for some partners. So in the case of a limited partnership, at least one partner must be a general partner with unlimited liability. At least one partner must be a limited partner, so this person's liability is typically limited to the amount of his or her investments. And then you also have an ALP. So an ALP, basically limited liability partnership, is similar to a limited liability company in that all partners are granted limited liability protection. However, in some states, the partners in ALP get less liability protection than in ALC. So this is really what it is. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. So when we talk about partnerships and taxes, you need to understand a few things. So first of all, the main tax form you need to really pay attention to is Form 1065. Okay, so this is actually this form is filed by the partnership for informational purposes. So it basically reports on the partnership's income, gains, profits, partnership losses, and deductions. And what happens here is that, so what I mean by informational return is that you do not pay taxes on this. When you file 1065, you don't pay taxes. You just inform the IRS of what's really happening, what's going on in your partnership. Okay, and each partner will then report their share of income, losses, and whatsoever on their individual and business income tax returns. Okay, and then so you have Form 1065. You also have Schedule K1. So each small business partner is required to complete Schedule K1 or a limited partner member statement. And this outlines how much partnership profit a partner has received from the partnership and how much income tax that they will have to pay. And then you also have a Schedule SE, so that's Form 1040. So for general partnerships and unlimited liability partnerships, you must pay self-employment taxes using the Schedule SE form. And this partnership taxes are what you pay into Social Security and Medicare. And it usually amounts to about 15.3% of your business income minus certain deductions. Now, when we talk about partnerships, we also have to talk about estimating and paying taxes. So you're probably wondering how you do all the math and figure out your tax payment responsibilities are. Luckily, some tools can assist you, including balance sheets. So a balance sheet is actually a statement that shows the financial position of a business, of your partnership in this case. So there are sections for assets, liabilities, and the equity an owner has in the business. Liabilities and owner's equity must equal the total asset a company has. That's what we call the accounting equation, okay? And you also have profit and loss statements. So a partnership profits and loss statements allows you to track your business's expenses and profits throughout the year. So it should include all business transactions for the year, and the sum of profits minus the sum of partnership losses equals your business's net income. So that's the P&L. And then you also have the cost of goods sold. So if you sell products, you also need to calculate the value of your inventory. And so this includes any items you have purchased from a wholesaler but has not yet sold. So the cost of goods sold is actually the difference between how much inventory you started the year with and how much you have remaining at the end of the year. So you need this worksheet to help you estimate the amount of tax you must pay every single year. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about how partnerships are taxed. Now let's talk about when a partnership profits tax, because there are certain cases where you have losses and certain cases where you have profits, right? So partnership profits are taxed annually. So according to the IRS, partnerships must file their Form 1065 no later than March 15th, okay? So if March 15th falls on a weekend or a holiday, the due date is the next business day. So please don't forget, we're not speaking here about April 15th. April 15th is actually the deadline for corporations, so C corporations. So, but March 15th is for partnerships. So this gives individuals 1 month from the time that 1065 is completed to file their taxes with the Schedule K1 attached, right? Because individuals must file April 15th and the partnerships must file March 15th. So 30 days. And it's important to understand the concept of self-employment taxes as they apply to partnerships. So self-employment taxes can be a little tricky. A few tips to help you understand self-employment tax and your role in the partnership include: limited partners don't pay self-employment tax. And so you also need to factor in Social Security and Medicare contributions. And you need to know what limits apply to Social Security contributions. So when we talk about limited partners don't pay self-employment tax, if you are an unlimited liability partner or a general partner, you must pay self-employment tax. However, limited liability company partners don't have to pay, as their profits and holdings in the company are typically lower than liable partners. So when we talk about factoring Social Security and Medicare contributions, self-employment tax equals the amount you would have taken out of your paycheck by your employer, plus the employer's contribution to Social Security and Medicare. You need to know what limits apply to your SS contributions. There are limits to how much you are required to contribute for Social Security. So for this year, the limit of ordinary income tax is around $160,000, okay? And now, how do partnerships handle expenses and deductions? Well, you can list certain expenses and deductions on your tax return with a few caveats, including the expenses must have occurred while conducting limited partnership business, and your limited partnership agreement must explicitly state that the partnership covers these expenses. And some possible deductions you might claim include home office expenses and travel costs. Let me give you a few pro tips here. So when we talk about partnership taxation, you got to really be clear about the dates for the return. The returns are due. I think I told you before, it's March 15th, not April 15th. And the thing that you need to understand here is that there are changes all the time in terms of what's happening for partnership taxation. One thing you need to be clear about is that you need to automate things if you can. If you have a lot of partners and you need to actually send out their schedules K1 before the April 15th due date, then you need to automate things. It's one of those things where, depending upon the number of partners that you have, you can say, you know what, I'm going to use accounting software to sort of tax software like TurboTax or H&R Block, self-employment, or S corporation section to be able to automate things. It's either that, or you basically can outsource a whole tax preparation service to a third party, to a CPA, to an EA, or to a tax attorney. You gotta have that, unless you yourself, you who are listening to me right now, you have a background in accounting and taxation, and you understand exactly what you're doing. Otherwise, it's just a lot better to outsource the whole thing. And when I'm talking about outsourcing the whole thing, it's important to really keep all the partners in the loop, all the general partners, but also the limited partners, because if there is information that the accountant needs, the partners must react really fast. Okay, it's all about speed here. It's all about responsiveness, and that's why we tell all our viewers to actually automate things and to outsource as much as possible. And please, another important element is to actually the whole concept of paper trail. You got to keep good records. Your partnerships must keep good records. All the expenses. There are some expenses that the IRS always audits, and so you want to have good record. You want to keep good records to make sure that things like business meals, business travel, all those things are really, really well documented. This is very important. It's going to help you out during tax time. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about how partnerships are taxed. One thing I want to say here is that I think I've said this to you before. If you want to accelerate the whole taxation, the whole partnership taxation process, it's important to keep a few documents, especially a few financial statements, ready so that your accountants, your CPA, your EA, or your tax attorney can really file your taxes a lot faster. Okay, so to file your partnership income taxes, you'll need to provide some financial reports and other documents to your tax preparer. So those documents actually include the top three that I just spoke to you about earlier. So we're speaking about a balance sheet, we're speaking about a profit and loss statements, and we were speaking about the cost of goods sold. Let me really elaborate. So for the balance sheet, you are going to provide a balance sheet for the beginning of the partnership's fiscal year and the end of that year. So we have beginning balance sheet and we have ending balance sheet. So, by the way, balance sheet is also called a statement of financial position or a statement of financial condition. So, if your tax preparer is actually giving you words like statement of financial position or statement of financial condition, your tax preparer means the same thing as balance sheet. Those words are interchangeable. And then you also have a profit and loss statements for the end of the year. So, your tax preparer doesn't need to have the beginning P&L statement and any P&L statement. No, P&L statement covers a whole year, and that's totally fine. So when you hear the terms P&L, profit and loss statements, income statements, statement of income, all those words are interchangeable, so they mean the same thing. Okay, and so you basically show your revenue, you show your expenses, and then when you deduct your revenue from your expenses, you have your net income or your net loss, depending upon your fiscal year. And then you have to provide also information to calculate the cost of goods sold. The reason the tax preparer needs this information is because the IRS wants to have a clear idea about your inventory. So cost of goods sold, we're talking here about inventory's beginning balance and the ending balance. So the whole thing is that your tax preparer will have to do some calculation depending upon the kind of inventory valuation method that you have, LIFO, FIFO, or average cost, to sort of determine what kind of cost you have. So when we talk about partnership taxation, it's important to understand that we have to actually touch on the subject of estimated taxes for partners in partnerships. So the partnership itself pays no income, right? I said this before, no income tax, because 1065 is really an informational return. You file with the IRS along with the Schedule K1 to let the agency know what's really happening within your partnership. That's pretty clear. So because the partnership itself doesn't pay income taxes, it doesn't pay estimated taxes. Now, a partner, however, may have to pay estimated taxes if they expect to owe $1,000 or more in taxes when their return is filed. So when they file their own 1040, they have to really have a clear idea how much they could actually owe. So quarterly estimated tax due dates are usually April 15th, June 15th, September 15th, and January 15th of the following year. And so you may pay estimated taxes by check with a voucher or by direct pay. So we're speaking here about electronic payment. And so as with the filing tax returns, those affected by let's say stuff like let's say catastrophes or like weather storms, whatever. They always can file for an extension. That's not a problem. You also need to think about state partnership taxes. So partners must pay income taxes on their distribution of profits in a partnership in the states where the partnerships are located. And so partnership taxes are paid on the individual partners' personal state tax returns, okay? And do not forget also self-employment taxes. So general partners in a partnership are not considered employees, but they are self-employed. So their income, for that matter, as a partner may be subject to self-employment taxes. So we're speaking here about Social Security and Medicare taxes based on the partnership type. So general partners usually pay self-employment tax on their earnings with some exceptions, but a limited partners share of partnership, as I explained to you earlier, is not subject to self-employment taxes, okay? There are exceptions there too. So if you must pay self-employment tax, it's important that you prepare and file a Schedule SC to report your partnership income and calculate the self-employment tax amount. And the tax amount is added to your personal tax return. So this is kind of really important to remember. Another thing I want to talk about here is I want to talk quickly about husband and wife partnerships. Now, when we talk about partnerships, husband and wife partners are basically considered qualified joint ventures. So this is QJV. And so if you and your spouse are the sole owners of a partnership, not an LLC, you may be able to elect qualified joint venture status and file 2 Schedule C forms instead of filing the partnership tax form. So you don't need to file an election to do this, but you must meet certain specific qualifications. Both members must materially participate. There must be no other owners, and they must file a joint tax return. So let me give you a few extras here before we close to this conversation. So when we talk about partnership taxation, there are some partnership level issues that you need to really pay attention to. The thing here is that you need to understand that the partnership actually is not paying taxes. That's for sure, right? But so the partnership remains a tax reporting entity that must file an annual partnership return. And so it's one of those things where you have to always see the reconciliation between the income and loss and all other materially, I would say, operational or data that the partnership sends to the IRS versus what the individual partners are reporting when they actually file their Form 1040. It's one of those things, again, where we're speaking about reconciliation in terms of the IRS is looking at the data that the partnership has sent to it, and then is reconciling that data with the data that the individual partners are sending to the agency. And one thing I want to say here is that you always have to have the element of timing, because remember, Form 1065 is due March 15th, and all the Form 1040 are due April 15th. So if the partnership is not acting fast, because that's why I was talking to you earlier about automating the whole tax preparation process within the partnership, because if you have a lot of partners, let's say you have 10 partners or you have 20 partners or 30 partners, and those partners actually have to receive their Schedules K1 and they don't receive their Schedules K1 on time, they will not be able to file their tax returns and really comply with their tax obligations. That's why you want to automate things so people get their Schedules K1 promptly, and so they are able to prepare their own personal taxes and file as soon as possible. So timing becomes an important element when you really think about that. So bottom line is that you want to enlist the help of a professional, if you will. It can be a CPA, an enrolled agent, or a tax attorney to kind of help you out, or just use tax software to file your partnership taxes. Thank you so much for your attention. I really appreciate it. In today's conversation, I was talking to you about how partnerships are taxed. Let me do a quick recap here. So I give you the overview, and then I spoke about the pro tips, and then finally, I give you some extras. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.